This post on cash-free, debt-free completion mechanisms, I discussed the two most common types of completion mechanisms, lockbox and completion accounts. You need a completion mechanism to ensure that the business's balance sheet isn't manipulated prior to disposal, i.e. the seller could collect all the monies owed to the business and not pay suppliers to increase the amount of cash in bank and then take this out before completion. This would leave the buyer with an adverse working capital position and potential cash flow issue. The lockbox protects the buyer through warranties, which are a contractual obligation in the SPA, that's a shared purchase agreement, and the completion accounts mechanism protects buyers through post-completion adjustments. If the SPA uses completion accounts, it will be agreed that either the buyer or the seller will produce a set of accounts to show the balance sheet position of the target on the day of completion. Typically, this will be done within 1 or 2 months post-completion. The SPA is likely to set out a target working capital position. This can be subjective, but could be the working capital at the last management accounts date, the last year-end date, or an average over the previous few months or year. Once the completion accounts are finalised, the SPA will contain a mechanism to either increase or decrease the total amount paid for the business, depending on whether the working capital at completion is less than or greater than the target working capital. Still with me? Let's work through an example. So Wendy's Widgets has agreed to buy its competitor, Widget Express, for $1 million on a cash-free, debt-free basis, assuming that the normalised level of working capital is as per the year ended 31st December annual accounts. So at the 31st December, we've got stock and debtors totaling 600k, and then the liabilities, short-term liabilities, are trade creditors, VAT, PAYE and corporation tax, and they total 300k. So 600 minus 300 is a target working capital of £300,000. So a couple of months later at completion, the working capital position's moved. We've got current assets of 675k, current liabilities of 325k, giving a working capital of 350k. So as per the terms of the SPA, we'd have to make an adjustment here. There would be a 50k working capital adjustment. There was cash in the business of 60k and there was a loan of 95. So the adjustment would be add on the excess working capital and the cash and then deduct the debt, which gives a upward revision of 15k, i.e. Wendy's Widgets would need to pay the sellers of Widgets Express an extra £15,000. Sounds fairly simple, but there are areas which can be contentious. What is working capital? It doesn't have a legal definition when considered as part of a business sale. Most people will take it as current assets, excluding cash, minus current liabilities, but as it's not legally defined, there is scope for disagreement. Uncertainty. In the example, there was an upward adjustment, so the sellers are likely to be happy, but if there'd been a downward adjustment, the sellers would receive less than they originally envisaged. Sellers often prefer to know exactly what they'll receive, so tend to prefer the lockbox mechanism. Determining the target working capital. Sellers will want to lower the target working capital to increase the likelihood of an increase in total consideration, and vice versa. This can be a problem in cyclical businesses where working capital varies significantly throughout the year. As the target figure is subjective, there is a risk of disagreement. Free cash. In this example, I assumed all cash to be free for simplicity, but in reality, if stock is slow moving or working capital is minimal or negative, then not all cash will be classified as free, i.e. in excess of working capital requirements. If this is the case, the buyer may wish to include a target cash position as well as a target working capital position. In the example here, if the target cash position was 50k as per the year-end accounts, then the cash adjustment would be 60k minus 50k equals 10k, thus making the overall adjustment to be 50k for excess working capital, plus excess cash of 10k minus debt of 95k, giving a minus 35k adjustment. So in this scenario, the seller would have to pay the buyer 35k, reducing the overall consideration. Well, I hope that was interesting. If you enjoyed it, drop a comment, like and subscribe.